Hello and welcome to January 2025. How exciting to say something like that. 25 years past Y2K. Isn't that just wild? Um, and so we are going to dive into our Elevánt Insights webinar today, where we have an awesome guest, somebody that's going to help us dive into the current markets and understand not just where we've come from, but where we're going into 2025. Coming into 2025, there's, and even just a new year in general, it seems like there is this optimism surrounding new beginnings and, goals and ideas and resetting and things like that. And no doubt we've had that in our minds at Elevánt as well, both personally and as a business. But one of the things that is accentuating that coming into 2025 is also it feels like we've come out of this COVID wave of 2020, 21, 22. We had a market crash in 22, and then 23 pretty good, 24 pretty good. Now we've got a wildly new government that is going to be taking effect here in just a few days. And so my mind was certainly turned to new beginnings in lots of different ways and lots of different areas of my life. And so as I was thinking about the Elevánt Insight for this for today, and which is for if you're new to what we do here, just in an effort to keep the conversation on the things that we care the most about, and to essentially raise our plane of thinking. We do an Elevánt Insight each at the beginning of each one of these meetings. And so the quote that I have for that today is, "Every day is a chance to make changes to create the life we want." And what a simple topic. It's something we definitely know, that a new year, a new presidency, a new quarter century even is certainly a line in the sand that can yield the idea of new beginnings. But just as a reminder, every single day we have an opportunity to make changes in our daily routine that can affect and impact our daily lives. And so I would, as I would myself, just encourage each of us to determine what life we want to live, both financially as well as personally, and make the changes that we need to today to pursue that life. And so today I'm going to turn the introduction of our guest over to Dan King, and he's going to introduce our guest and jump into the topics of conversation around the market today.
Great. Thanks, Brian. Appreciate that insight. I'd like to take the time now to introduce Dr. JoAnne Feeney. She's portfolio manager and member of the investment committee with Advisors Capital Management, LLC. Prior to joining ACM, Dr. Feeney was a senior equity analyst for more than 10 years at boutique firms, where she focused on the valuation of semiconductor companies. Dr. Feeney also consulted for the Federal Reserve, the International Monetary Fund, the World Bank, while an academic at places like the University of Albany, State University of New York, Stern School of Business, New York University, and the University of Colorado at Boulder. Dr. Feeney has appeared often on Bloomberg, CNBC, and is frequently quoted by Barron's and the Wall Street Journal. Dr. Feeney received her BA in economics from Union College and her PhD and MA in economics from the University of Rochester. With that, Dr. Feeney, go ahead and turn the time over to you.
Okay, thanks, Dan. Thanks for the introduction. It's great to be here with you guys. I love giving these market updates, and this year may be one of those where people are feeling like there's more uncertainty ahead. And so we're going to try to put that in context. I'm going to share my screen here and show you some slides. These will be a little bit detailed on the macro front, but we want to always put this in context of the market and opportunities. So I'm also the portfolio manager for T3 balanced, as well as T4 and T5. Serve on the investment committee, where we all work together to vet new ideas, to consider the macro environment, the political environment, and the risks that we're all facing. And we work together to judge how best to adjust our strategies for those risks. I'm also co-manager of the growth strategy, where I work closely with my colleague Paul Broughton on trying to figure out what kind of opportunities might be sitting in the growth world that, take a little bit more risk than we do in the balance strategy. So let's move into some of the questions we want to talk about today. What happened, as Brian sort of gave a little bit of a preview to for the last few years, what happened particularly last year. Consumer was a big part of that. We want to know if they're going to continue to spend like they have done. Looks like we're in for higher interest rates for longer. And so what does that mean? And obviously, one of the big questions is what's going to happen to the U.S. deficit and the debt with the rise we've seen over the last few years, particularly because of COVID and some of the spending packages that were passed over the last 4 years, and some of the hints we're getting from the new administration as to what they plan to do. How much of a risk is that to investors? And some of the other policy changes that have been talked about, which presumably we'll learn more about in coming months. And then, of course, there's geopolitics. It isn't just what's going on in Ukraine, Middle East, but also let's not forget about the risks over on the other side of the world in China and Taiwan in particular. But first, let's take a look at the markets. Where are we? Where were we last year? Okay, so in 2024, the total return in the S&P 500 was about 25%, but more than half of that, 13.4 of that 25% came from the Mag 7. That's the Amazon, Microsoft, Tesla, et cetera, Apple, et cetera. So just over half of that return was driven by a mere 7 companies. And you throw in another couple like Broadcom or Lilly, and you explain an awful lot of what happened last year. In other words, the market went up, nice to see 25%, but it was very concentrated. In fact, I came across a statistic that said that only 30% of the 500 companies in the S&P 500 came in above average in terms of return. So 70% were below that average return of 25%. The weighted average, the appreciation of the S&P 500, just straight average, was about 48%. But when you weight it by their size in the index, they were up by 59.5%. So the return of all the rest was a very respectable 16.6%. So when you look at your portfolios, chances are, no matter where you're invested, you're probably more diversified than those 7 companies. You're probably more diversified even than the S&P 500, which has become another word for the S&P 500 is the S&P 500 growth, because it's really about those growth companies. So one has to be a little bit careful about comparing oneself to the market at this point, because the market is not as diversified as it used to be. And we can see that in some of these pictures. So this is a chart of a few different indices. Okay, the white one is the Mag 7, and that's just 2024. And on the right-hand side, you can see the percentage increase. So this is, again, a little bit different from what we saw before, but about 66% appreciation. And the blue line is the S&P 500, about 24-25%. The bottom line, which is in sort of an orange-ish color, is the equal weighted version of the S&P. The S&P is a market capitalization weighted index. Bigger companies are weighted more heavily. So if we look instead at an equal weighted version of that, then what you're picking up is what did the average stock do? And the average stock in the S&P was only up 10.9%. So a very different world out there, depending on how you think about the market. And if we look a little bit at things a different way, we want to compare what the S&P 500 did versus more dividend-oriented indices. So the S&P 500 is now the white line, again, up 23-24%. The blue line is the Wisdom Tree Large Cap Dividend Index. So these are large cap stocks in the S&P. And that was up considerably less, only about 17%. And the another measure of dividend stocks looks at just those highest yielding companies out there, like the Kinder Morgans of the world, for example. So those with the highest yields make it into this final index, the orange line. And those, again, were only up 10%. So it was really quite a different market, depending on where you were invested, depending on what you're looking at. And for all of you, right, your goals for your investment portfolios may be very, very different from one another, right? Some of you may be looking for taking less risk, generating more income, and those dividends, right, are giving you that income. You perhaps are living on that income, and that enables you to be a little bit insulated from the day-to-day, month-to-month fluctuations in the prices of the stocks that you own in your portfolio if you're using the income. We refer to this as the apple orchard approach to investing, right? You want to let the trees continue to grow. They have branches, and you eat the apples off the tree. Those are the dividends. And you care a little bit about the value of the trees themselves. Those are the stock prices. But what you want to make sure of is that more and more apples come your way year after year because you're consuming those apples. And you want to avoid cutting down any trees. You want to avoid having to sell stocks if you're using your portfolio to generate cash to live off of. So that's why our strategies at ACM are really varied depending on how much income people want to take off of their portfolios. And so we offer those like T3 balance with a dividend yield of about 3%, T4 at 4%, T5 at 5%, and then we have something called income with growth, which has a yield of about 6%. So that's how we organize our thinking here, and we're trying to do that and minimize risk at the same time, and also create some appreciation. Just FYI, T3 balance this year actually outperformed the S&P 500. And just so you know, that is not supposed to happen because we're designing T3 to have a 3% yield, and the S&P yield is only about 1.5%. So we're trying to get twice as much yield. And the only way to do that is by having higher dividend yielding stocks in the portfolio. And that necessarily means we're holding companies that shouldn't be growing that fast. And it's also designed to be more conservative. We don't want it to we don't want this portfolio to fluctuate as much as the market does. So it was kind of a bit of a fluke this year. We happen to have owned areas of the market which were exposed to some of the really strong structural growth drivers, cloud computing, AI, some consumer, and so it just worked out that way. But I want to reset expectations. This shouldn't happen because if you want a more conservative portfolio, it means you might miss some of the top, but you'll also hopefully miss some of the bottom. And so that's how we're trying to design things. Okay, so what is going on relative to broader history? Well, it turns out that the market's kind of expensive right now. And so that does and should make everybody a little bit nervous about how much more they can expect their portfolios to appreciate, or at least at what pace. Right now, when we look at a common metric for how expensive are stocks, the way we couch that is the number of dollars you have to pay for every dollar of earnings. So if the multiple of the price of a stock to its next 12 months worth of earnings is, say, a 10, you're paying $10 in the share price for every dollar of earnings. Well, it turns out the average over history is about 16. Typically, you spend $16 to get $1 worth of earnings. But today, the market is trading at about $21 or $22 per dollar of earnings, or 22 times. And that's a little bit on the high end. As you can see from this chart, the average for 30 years, 16.9. The 50-year average is closer to that 16 I mentioned earlier. So, we're definitely on the expensive side. And so one might say, well, boy, if it's so expensive, aren't you worried? Shouldn't we get out of equities? And the answer is there are plenty of stocks that are cheaper than that. And that's where we like to go.
JoAnne, I was going to ask, is that a statistic that's skewed a little bit by the Mag 7 as well? Because I know you look at the PE ratio of NVIDIA, for instance, is trading well above that 21.47. And so is that something where the broader S&P 500 may be trading a little less expensive than what that stat's showing due to the Mag 7?
Exactly. Yeah, and so we're going to look at that breakdown. We're going to look at it a couple ways, the Mag 7 and also the top 10, the biggest 10 companies in the index. So let's look at that one first, and then we'll drill down to the Mag 7. So what you can see here is the top 10 is trading at almost 30 times. NVIDIA, if you look out a full year, is trading at about 30-ish, 31 times. But there are some that are trading a lot more expensive. Palantir is a name that's floated around as one of the most expensive stocks out there. Tesla is more expensive. So there are a lot of names in the top 10. Palantir is not one of them, but that are skewing that higher. So the remaining stocks are only trading at 18 times. But still, when you look at history, the average of the top 10 was around just over 20 times, and the average for the rest was about 15.7. So we're still expensive. When we group everything together, those 490 stocks are still trading about 15% higher on a historical basis than average. And so, yeah, you can also find bargains. right? And one of the other things I like to point out is how much are those top 10 companies skewing the data and the market's perceptions of how expensive stocks are? Well, it turns out that the weight of those 10 stocks is almost 40% in terms of market capitalization. So the so-called market is 40% is just the 10 companies out of 500, which is very, very narrow, very, very skewed. And if you look at what those top 10 companies are doing, though, what you see is over here on the first column under R&D expense, the total R&D spend by the S&P 500, 40% of that or 41% of that is being done by the top 10. That tells you that the top 10 are high growth companies. They're plowing their gross profits back into the company through R&D so they can build new products, keep sales growing, keep earnings growing. And that helps to sustain those valuations. That's why they're more expensive, because they tend to be higher growth companies. And if we drill down to the Mag 7, right, and look similarly, well, it turns out the Mag 7 has gone up, 48%. That's their average return. And again, excluding the Mag 7, the market's only up 10%. Some of the numbers we looked at before. So they are definitely skewed in the share of the return they're generating in the market. And if we look at earnings growth over to the right, over here where it just says 22, 3, 4, and 5, those are the annual figures, they're growing faster. The Mag 7 earnings are growing on average 21%, and they're expected to grow even faster in the coming quarters. Whereas the rest of the market earnings are only growing 13%. So when you own the top 10, when you own the Mag 7, you're owning the high growth companies. And you can see that when you look at profit margins as well. They tend to be more profitable companies, right? They have better pricing power, they have better scale economies, and so they're generating more profits. But EPS growth is still the key driver of value in the market, of a value of a company. And what we've seen over the last few years is that a big part of the earnings that companies have been delivering has come from expansion of their profit margins. Now, we saw in the wake of the pandemic, right? We had the pandemic where everything fell. In the wake of the pandemic, we saw companies had a lot of pricing power, right? There was shortages everywhere, lots of demand, not much supply. Okay, I'll put on my economist hat here. What do you do when there's lots of demand, not much supply? You raise prices, and that's what happened. And so that delivered a lot of extra profits to companies, and we saw that in the data. And those profit margin things reversed for a couple of years and became a drag as profit margins fell, as you can see over here on the right. But we're starting to see that stabilize, and in fact, it ticked a little bit higher in the last year. And for the next couple of years, we're expecting pretty strong earnings growth, 14, 15%. And there's no breakdown here of where that's going to come from. So is it profits? Is it revenue growth? We'll have to see. Those are the only places earnings can come from. Either you sell more stuff or you sell more stuff at a higher profit margin. So things are looking pretty good, but let's look at the broader economy, because that's the context in which companies are selling stuff. And what we see here is that when we look at the big economy, look at the GDP, right, gross domestic product, we break it down by consumption, by what businesses are investing, by what the government is spending things on, and some other smaller things like residential investment and net export stuff we make here but sell to the rest of the world. And so what we're seeing is the consumer is the biggest part of that. And so we really have to keep our eye on the health of the consumer to get a feel for what the business environment's likely to be like for these companies that want to sell their products. And so the growth has been pretty good. And right now, we had a really strong jobs report on Friday. A lot of people being hired. That's a good sign. Wages still, growing at 3.94%. Inflation, we just got data out this morning, not moving down. And we'll talk a little bit more about that. Okay, and the consumer is pretty healthy. When we look at where their wealth and their assets sit, a lot of it's in their homes. A lot of it's in their bank deposits. They have pension funds and other assets. And their liabilities, primarily, again, mortgages, some credit card debt, some auto debt. If we look at the right-hand side, what we see is a decent picture of health in the household. The amount of money they're paying to service their debt, whether it's a mortgage or a car or a credit card, as a percentage of their disposable income, that is income after taxes, is certainly up since the depths of the pandemic. But that percentage of spend out of their disposable income to cover their mortgages, their car loans, their credit cards is still, only about 11%. And that's still lower than where we were pre-pandemic. So you'll see a lot of headlines in the news. Oh, credit card debt is up, but the actual burden on the household is still less than it was before the pandemic started. And that is less than it was for many, many years before that, right? So households are in pretty good shape, but that doesn't mean all households are. And this lower chart here on the right-hand side tells us a little bit about that. That green line is credit card debt. And this is the percentage of balances that are delinquent by 30 or more days. And that number has been rising, as it has also for auto loans. So it's up to 8-ish, 9%. So that's not the average consumer, right? That's not the average household. Those delinquencies are coming out of households who are struggling. Those same households who really took the brunt of the inflation over the past several years, whose budgets were really constrained by the higher cost of food, gas, rent for their apartments or their houses, right? These consumers really got squeezed and their budgets are tight. They're living month to month and they're starting to let their credit card delinquencies pile up. The rest of the consumer, the upper class, the upper middle income group, the middle income group, they're doing pretty well. And that's why we're seeing such a disparity in the performance of stocks in the retail space. Some companies are doing quite well, like Williams-Sonoma, TJ Maxx. Others, like Dollar Store and Dollar General, are doing less well because their shopping base is lower income consumers who are belt tightening. They have to. Their purchasing power, spending power has really been eroded by inflation. And they just don't have the extra income to be able to simply just walk in and say, I don't care if blueberries are $7 instead of $3, right? They're struggling with that. And so when we look at stocks to own, we want to be really cognizant of the disparity in the consumer and how some are behaving. And that's how we invest. Okay, but we also see that, again, on aggregate, consumer spending has been reflective of the real increase in disposable income. That is adjusted for inflation. This line has been above zero now for the last few years, and that means it's been growing. So think of real disposable income as the wherewithal to put more stuff in your shopping cart at the store, right? It's adjusted for inflation. It's how much stuff can you buy? And what this is saying is that people can afford to buy more stuff than they used to be able to. And that's been pretty consistent, not blow the doors off of growth numbers, but healthy couple 3% growth. So that's 2-3+ % more every year they could fill into their shopping basket. So again, it's been really carrying the economic growth that we've seen in the U.S. economy, and we want to understand how that's going to proceed. So where this increasing disposable income has come from has been people getting jobs. More people are employed. And so these big numbers here were post-pandemic, more people got jobs, payroll gains, right? Of course, the new jobs being created are getting smaller over time, as they should, right? Recovery from the pandemic is one thing, but ongoing job additions in the economy, should be considerably smaller than that. And so we've seen, the new additions trend down, but the more people that are employed for the entire US, the more money in the pockets of consumers, the more they have to spend. So that's been a big part of the consumer story, has been people getting jobs. And in terms of growth, we need more people in the US to produce more stuff. And so immigration has been a big driver of that growth. More people to produce stuff, whether it's goods, whether it's services. And so that's been a pretty good sized tailwind. We're obviously expecting immigration to fall in coming years, although this is this is not our projection, by the way. This is some JP Morgan view of the world, but we do expect net immigration now that we're entering 2025 and ongoing, given what the incoming administration is saying. They're going to put constraints on immigration. So we're going to get less of a tailwind from that. So the GDP aggregate numbers may not look quite as good. What it does to Americans and people working already in this country is another story, right? We may see wages rise for those people, because there are fewer people coming in to compete with them for jobs. And what we've seen over time is that both men and women have increased in terms of the proportion of the population, the number of them working. Right, labor force participation is a measure of the female population, what percentage is working, of the male population, what percentage is working. And then this is broken down by age. So working age people is classified 25 to 54, and then the baby boomer crowd over here, with good reason, pulling away from the labor market a bit. So their participation rate has fallen. Okay, so consumers have income to spend, and what we're seeing here is that, hey, look, the unemployment rate, during the pandemic obviously spiked way up, but now it's down just over 4%. Pretty much full employment, right? It's been rare for it to be below that, and wage growth is similarly around 4%. So pretty healthy look at the economy, right? So we're in a good place here at the beginning of 2025. Lots of people with jobs, wages are rising, unemployment is low. But headwinds may be appearing, right? Inflation, which is this figure here, both headline, which includes like gas prices and stuff, and then core, which excludes food and gas. Both of them were really obviously spiked up during the pandemic, but have come down considerably. But in the latest data, it's really kind of flattened out. The progress the Fed has made in bringing inflation down has hit a plateau, if you like. And so the question remains, what is the Fed going to do next? Is it appropriate for them to continue to cut interest rates, or are they going to wait and see what this new administration does on trade policy and on fiscal policy? Because both of those sets of policies bear on how much inflationary pressure there will be in the economy. And why this is relevant for investors is inflation erodes purchasing power, right, of the consumer, and that then affects companies that sell to the consumer. And interest rates trigger off of inflation. So higher inflation means higher interest rates, and that's the cost of borrowing, which you're seeing, right, in mortgage rates. You're seeing it in credit card rates. And that also inhibits the consumer if those are higher, and also businesses. Business wants to build a new factory and they need to borrow money to do that. Well, if interest rates are a half a point or a point higher, they might decide, you know what, that project's not worth it right now. Let's wait. And so it affects things like business expansion decisions, which affects things like growth and future employment opportunities for people who would otherwise work in that factory that's not going to be built, right? So there are lots of permutations here. And then we have to worry about one of those policies, not just immigration, but also tariffs, right? So a tariff is simply a sales tax, but it's a sales tax only on goods that are imported, as opposed to goods that are made here in the US. And this is a long, long history since 1930, when tariffs were used as the main source of government revenue. And also this period here in the early 30s was a misguided attempt by the then politicians to try to, I guess, shore up American industry by putting really big taxes on imports in the wake of, or in the middle of, the Great Depression. And it turned out that made it worse. That made the Great Depression worse and made it last longer because it made everything more expensive, whether it was a consumer good or whether it was, an industrial operation that needed to import something to use in their factories. So there's very rare consensus among economists. This is one of those. These tariffs were called the Smoot-Hawley tariffs, named for the Congress people that put them through or designed the bill. And anyway, they were widely understood to have made the Great Depression worse and last longer. So the concern now is that this administration that's coming in has talked a lot about putting pretty significant tariffs on imports from all around the world, 10 to 20%, and maybe 60 or something percent on China. Now, the hope, right, and this is, I think, where the conventional thinking is that, no, this is a negotiating tactic, right? Trump's just going to threaten these tariffs, and that way create incentive for the countries with whom we trade to lower their tariffs, or to stop barring American companies from having access to their consumers in other ways. And there are lots of ways that countries use what we call non-tariff barriers to tilt the playing field in the favor of the home team. And so, there's lots of room for those kinds of negotiations. They've been used over and over through history to try to get countries to be more willing to play fair And so, we're obviously going to see how this comes out. This is again, a JP Morgan projection on and an assessment of what the incoming administration has proposed. And we're going to have to see what actually transpires. But obviously, we'd be worried about this from an inflation perspective and from a cost of living perspective for the consumer, which drives the economy, and for businesses who, like the auto industry, obviously a lot of cars are built both in the US and say in Mexico, and they go back and forth. Okay, let's put this thing over in Mexico, let's add the muffler, and then let's put it over here and do the next thing. And so there's integration right now of supply chains that is so extensive that it would be very disruptive if there are any significant barriers to that. So, we're thinking that this is likely to be threat to negotiate, right? Threat to create a better policy environment for all players. We'll see. But that's something we have to watch. And so what we do is we look at our companies and we find out, okay, how much exposure do you guys have to, say, importing stuff from China? How much exposure do you have from importing from other countries? And so we're trying to assess, where those risks are highest, and try to maybe stay away from those or add a diversification element someplace else. Consumers primarily buy, about half of the growth in consumer spending was on durable goods like washing machines and cars and things like this, but also on services, right? Post-pandemic, people were out at restaurants, they were traveling, etc. And so that's, again, a detail that we tend to look at. Okay, now there's the macro, and then there are companies and earnings. So the macro is the state of the playing field, if you like, and then the companies are out there trying to do their thing. And so what we like to do is dig down into the details of what kind of earnings growth can we expect. So this is last year, this is 2024. And what we saw, and this is just the 500 companies in the S&P, is that on average, earnings grew by 9.5%, close to 10% last year. And we haven't got all the data. This is an estimate. Obviously, companies are just now beginning to report their fourth quarter results. So where they're estimated to have grown about 9.7% or 9.5%. And where we saw the greatest growth was in communication services from the likes of, say, a Google or a Fox or some others, Verizon, AT&T. Information technology grew almost 18%, their earnings. And again, when you look at stock prices, they often reflect future earnings opportunities. How much can you company that I'm going to own, how much earnings are you going to deliver to me next year? How much growth are you going to deliver? Not just next year, but the next 5 years. So we like to look at sort of where we are now, how much growth have we been able to see these companies generate, and then how much are they going to do for us in the future. But I want you to take away from this a couple things. The companies that did very well last year were primarily in these sectors: comm services, infotech, banks, financials more broadly, and consumer discretionary, led by Amazon, right? The laggards were over here: industrials, materials, energy, right? We saw a decline in oil prices, right? We saw some regulatory issues. Materials suffered from high natural gas prices on the one hand, and lower prices of goods they wanted to sell because China demand fell off a cliff, and China's a big consumer of materials. Industrials were still going through a post-pandemic period of inventory adjustment. In other words, in the wake of the pandemic, everybody sort of freaked out and said, we never want to get short of inventories again. And so companies built up a lot of inventories of the stuff they were sourcing, components, and of the stuff they wanted to sell. And that was great. After the pandemic, 2021, 2022, they sold a bunch of stuff. But then it turned out companies sort of decided, well, maybe we don't need to keep that much inventory around. And so as demand came down, all these industrial companies that were formerly selling into other companies building up inventory said, oh, shoot, now we have too much stuff. So there's kind of been a couple of years of working down the levels of those inventories. And that really cut into earnings for these companies. And so that's an opportunity. We could see a nice recovery over here in industrials. Another underperformer was healthcare. Healthcare also similar trajectory, sort of post-pandemic quick recovery, but then interest rates went up, which made the cost of doing business for biotech, made the cost of installing new equipment at hospitals go way up. Interest rates had a big negative impact on the healthcare sector, particularly medical devices, analytical tools, and that sort of thing. So what might we see this year, 2025? Well, the S&P is expected to grow 50% more in earnings, not 10%, but 15%. Once again, the leaders include infotech. In fact, infotech is supposed to grow faster. Why? Because instead of just a handful of companies like NVIDIA and Broadcom doing particularly well, there's a view that now it's software's turn. Software kind of took a hit. Again, high interest rates hurt them. And so now we could see those companies being the users and deployers of AI really finding some new traction in terms of growth. So that's an exciting area. Healthcare, laggard last year. Well, interest rates have come down a bit, and a lot of the inventory buildup we saw there, as well as in industrials, is now worked down. So we no longer have that headwind. And similarly for industrials, we no longer have that headwind. Interest rates at least leveling off, if not falling more, is a real help to them. And in materials, another flip. So sometimes when you look at these earnings growth, you have to remember where we were. These guys had a lousy 2024. So part of this is a little bit of mean reversion. Okay, they're going to catch up, deal with these inventory problems. We don't know if we're going to see this kind of strength in materials. China is a little bit iffy. You can't trust their data, for one thing. They have a big real estate problem in China. They have a big debt problem. They have a big population demographic problem. Materials, again, tends to supply the whole world. And so you really have to look at the global situation for that sector. But bottom line is, there's a lot of growth expectations built in from the continuation of some secular trends, as well as some cyclical recoveries. And that creates an exciting opportunity for investment this year. But be aware that part of the reason the S&P 500 went up so much in 2024 was because of this anticipation of further growth in 2025, right? You never own a stock for what it did in the past. The past is done, right? When you own a stock, you own a piece of the company. You care about what they're going to do for you in the future. And the amount you're willing to pay for that stock today depends on how much earnings you think they're going to generate, not last year, but this year, the next year, and ongoing years. That's going to fundamentally underpin the value of that company. And so when we see the stock appreciation of 2024, we have to acknowledge, right? That's driven by this chart. It's driven by the expectations of growth this year and next year and the year after that. And so really this year then, stock price moves are going to depend largely on what people think is going to happen in 2026 and how much more growth we can expect. We don't see, again, big shock to the system right now. We don't see signs of, for example, of recession. We didn't see them before, by the way, the last couple of years, and everybody was saying a recession's around the corner. We were saying, no, we don't see it. The macro data looks strong. Now, recessions are inevitable and sometimes they're unpredictable. We're always keeping an eye out for them. But right now, the setup looks pretty solid. Don't know if we'll get 15% growth. We'll see. And a lot of that, excitement last year happened from this AI thing, right? The creation of artificial intelligence capabilities and those capabilities being built up and deployed. We haven't seen anything yet like we're going to see in terms of AI applications. This is all so new. What we are seeing, though, is the capabilities for doing AI, for applying AI in healthcare, in financials, in government, in consumer products. We're seeing those ideas beginning to percolate, and we're seeing companies like Microsoft, Amazon's web services division, Google's cloud division, Facebook. They're all building the capabilities to do and deploy AI applications by themselves and for their customers. And that's, if you're paying attention to the news, you've seen that the main supplier of the super fast, capable processing units from NVIDIA, also called accelerators, those are right now almost the only game in town. So they're buying tens of thousands, hundreds of thousands of these chips to build these data centers to run these AI applications. And you can see some of the spending in the tens of billions that has been happening from just a handful of companies: Alphabet, that is Google, Amazon Web Services, Facebook or Meta, Microsoft, Oracle, and there are others. And the combined spending of these guys was like 126 billion, expected to go up to 197, 234, 250 billion by 2026. This is a boatload of money. A lot of it's going to go to NVIDIA, but other players are working their way in, like AMD, like Broadcom, in conjunction with Google, who are designing their own chip, and others. Marvell is involved. And it's also, by the way, driving up the demand for electricity. In the past, it was crypto mining that drove up demand for electricity, but that's been massively dwarfed by the demand for electricity from data centers more generally, and we're expecting to see more from AI. And that's why we're hearing more about nuclear as an alternative to gas-powered and certainly coal-powered plants. And we're likely to see innovation speed up in the electricity generation area because of this need, right? Necessity being the mother of all invention. Okay, so right, so this is a little bit redundant. Oh, this is just the job market as a whole. The reason why the Fed changed course and said, okay, we brought inflation down from 14% down to 3%. The Fed then looked at the labor market, and they looked in particular at this blue line, the job openings number. And what they found was the number of job openings was shrinking, since about 2022. And that meant labor wasn't, labor markets weren't as tight anymore, right? And the Fed has a dual mandate by Congress. They have to do two things. They have to maintain stable prices. That's one of their mandates. And they have to maintain or attempt to maintain maximum employment. And so when this started happening, job openings started falling and unemployment started ticking up a little bit, the Fed said, okay, we've gotten pretty far with inflation. Looks like we're on a good trajectory. We're going to now turn our attention to the labor market because we don't want this to continue. We don't want this to happen where unemployment is way above job openings, right? And so they started to cut interest rates. Why? Because it makes the cost of business cheaper. It makes it easier for firms to go ahead and build that new factory and employ more people, right? It makes it easier for households to buy what they need. And so that's the reason why the Fed shifted course. Now, that jobs number that came in Friday was so great, it's sort of hard to argue that there's any problem in the labor market. And so expectations have been shifting. Now, the Fed may not need to cut at all this year. It might be okay for them to refocus on inflation again because its target is 2% and we're stuck around 3% or 2.5%, depending on what number you look at. But they still have more work to do. So inflation, though, is mostly falling. And if the Fed pauses its rate cuts, we're likely to see inflation continue to come down. And that's a good thing. We like stable prices. And also that would then tend to bring down interest rates. This data is a little bit old. Rates have come up again. But the point is, lower inflation usually means lower interest rates. Okay, now here's another risk we're looking at, and that is the government deficit. And so there's a spending level of $7 trillion, but they're not bringing in that much money in terms of revenues from income taxes and capital gains taxes and other things. Income taxes, payroll taxes, corporate taxes, right? There's a big gap here. And we haven't heard anything from the incoming administration that would suggest that that's going to get to be a smaller gap. In fact, it sounds like it's going to be a larger gap. The reason is because they're going to extend the tax cuts that expire soon. And they have some spending programs that they want to pursue. Now, there's this government office of whatever, DOGE, Director of Government Efficiency or some Department of Government Efficiency that Elon Musk is involved with that hopes to bring some spending down. Very challenging. As you may be aware, and looking at this chart reveals it, what is the budget look like? Okay, you've got net interest, can't cut that. You got to pay your bills. You got to pay for all that borrowing the government did, right? You got Social Security. Well, they pretty much said they're not going to change that, right? They're not going to raise the Social Security age, and they certainly aren't going to cut it for next year. So we're not going to change that. Medicare, not going to change that. Medicaid, well, that's one they might politically be able to get away with cutting, but there's not much to cut, right? The deficit is almost $2 trillion. Medicaid's only $600 billion. Other mandatory stuff, 12% of the budget. Defense, or maybe they'll trim that a little bit, try to make it more efficient. Maybe. I mean, it's possible they can make stuff more efficient in here, and that's maybe their hope. But I don't think we should get our collective hopes up that we're going to see a big cut, even from efficiency measures. There's just not enough places to work on it. And so we're kind of stuck with this disparity between taxes, tax revenue over here, and spending over there. And we shouldn't expect tariffs to be much help. Even if they doubled or tripled the tariffs, it's a drop in the bucket. They're only $76 billion, right? So kind of not much help. Okay, so interest rate expense is going to continue to rise. The net debt as a share of GDP is going to continue to rise. We're way above where we were even in World War II. And that's concerning. Now, if we continue to grow at a good rate, this is all sustainable. This just may not be the best way we should be spending our money as a country, right? And particularly at a time when growth is good, that we're not in a recession. Why are we borrowing so much? So economists are like, no, 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 no. When it's not a recession, government budgets should be surplus, not deficit. So that when there is a recession, you have extra money lying around that you can then use for all these unemployment programs that you need to support. We're not in that world. Okay, but just want to wrap up with some perspective. So there's a lot of risks out there. There's the geopolitical risk, which I only mentioned, but I think pretty much people know that they create a new source of uncertainty. What we try to do in particularly in balanced, right, is to take a barbell approach in T3 balance in particular, where we have about 20 to 25% growthier stocks. These pay a 1% dividend or less. And then the rest of the portfolio is more income oriented. Mature companies, less volatile than the market, and give us some defense against a downturn, right? Whether it's a TJ Maxx where people tend to go to shop when their belts are being tightened, or something else like that. But what everybody should be aware of is that pullbacks happen. They happen all the time. And these red circles here with the minus signs, those are the marks of the lowest point of the S&P 500 in each of those years. So 1980, down 17%, but the market finished up 26% that year. So that's what the gray bars are. Now, there are certainly some years when the market ended up down, but just compare, just eyeball that. Obviously, the market tends to go up more than it goes down. And even in years, oh, gee, look at that. Almost every year. Well, every year, the market pulled back. Every single year. In fact, more than half of the times, half of these years, the market pulled back, more than 10%. So pullbacks are normal. They're going to happen. But it doesn't mean that the market's going to end up down. And even if it does end up down, most of the time, you get a few up years afterwards. 1981 recession, the market ended up down. But then we had a run of up years, right? 1990, again, a run of up years. Now, the only time when we saw a few down was the pretty significant and drawn out recession in the early 2000s, right? We had 3 down years, but then we had some pretty nice recovery. And then, of course, the banking crisis, the financial recession in 08, 09. And that was a tough year, but look at that long string of recovery. So you plot out the S&P 500 and it goes up with lots of bumps along the way. This past year, the biggest drawdown was 8%. And we ended up 23, 24%. Okay, so be prepared for pullbacks. The important thing is to stay in it for the long term, right? Because while the volatility of stock returns ranges from a great year of 52% up to a terrible year of 37% down, if you look at a rolling average of, say, 10 years, then the spread is only a down 1% to up 20%, right? And so the longer you're in, the more you're going to compress those returns for your portfolio. You're going to get to the good stuff. And so that's why we try to design portfolios that have some buffer to volatility, so it's easier to stomach those ups and downs, and why a lot of clients that are in like balance have that income portion, which says, okay, I can ride this out, I'm getting this income. So that's our approach. I'd be happy to answer any, Brian, Dan, if you want to dig into any details, I'm happy to do that.
One question that I have is, it's really interesting when the jobs data comes out and it's good, the market goes down that day.
Yeah, that's because they then figured that's because the Fed's not going to cut rates if the
exactly. And so, but not cutting rates is, if we really think about it, is a good thing, because now we've got more ammo, more arrows in our quiver the next time we do need some assistance from a policy.
And it's confusing to most people. But
well, and I think it's really proof that the market in the extreme short term is emotional, just like we are. But over time, the markets settle themselves out. Corporate profits, earnings per share, these are drivers that really produce long-term investment results far more than tweets or news
Yeah.
of the day or whatever it might be.
Yeah, it's what the companies can produce, right?
Yeah.
Ultimately determines their value.
One last question for you, JoAnne. And I on most market update scenarios, I like to ask this question because we live in a state where in Idaho we have a lot of people who who look for opportunities for growth when those opportunities are there, but that are also quick to get nervous, right? Like most of us are.
Yeah.
And so I heard a lot of optimism in your mindset, not necessarily expecting, a 15-20% year, but that we have reason to be optimistic. Is that a fair thing to state, that we have reason to be optimistic where we
Yeah,
are?
I mean, we have good secular drivers out there. And so again, what makes companies more valuable? It's the stuff they produce and the profits they generate. And right now we have this AI um, burgeoning of applications that we don't know yet how useful they'll be. But we know that companies across the economy are looking to see how they can use them to be more productive, to create new products, create new services. So that secular growth, that fundamental growth creates an opportunity. The companies are going to be more valuable if they're successful. So obviously we want to invest in some of that, but we want to do it in a diversified, careful way. We're not speculators. We're not traders. We're in it for the long term.
Yeah.
Well, very good. Dr. Feeney, thank you so much for your input and guidance and helping us understand what has gone on and the positive things that are in place for the U.S. and our economy going forward, and also those things to keep an eye on, what to watch for, and what to be kind of concerned about. We do appreciate that and appreciate your insight and the partnership that we have with ACM. To our
Our pleasure.
clients that are joining, as always, we don't take lightly the trust and confidence that you place in us. So you can see how it's important for us to have partners that can help us make sure that we're doing what is in your best interest. As we look forward to better weather in the markets and outside, we're looking towards spring and hopeful that each of you have set opportunities for goals in your life, and will continue to do so with your financial goals. And as such, next month's Elevánt Insight happens to be on Valentine's Day, so we'll give you one more reminder to make sure you take care of your sweetheart on Valentine's Day in our next webinar. Our guest for next month will be a government relations representative. We haven't locked that down for sure, but we're going to kind of dive into things a little more in detail. That'll give us almost a month of the new presidency and see how that's going. So again, that's February 14th. That's on a Friday. Again, we thank you, and thanks Dr. Feeney for her presentation this day. And we'll see you next month on Elevánt Insights.
Thanks all. Good to be with you guys.
Thank you.
All right.
Thanks so
Take
much.
care.